Financing is a crucial part to any real estate investment. Bad debt can sink a good deal. But when it comes to debt, there are a few different ways that you can pay it. And in this video, I'm going to walk you through interest-only mortgages and principal and interest payments. So make sure you hit the subscribe button right now so you don't miss more videos about building wealth through multifamily real estate. And if you don't know me, I'm Seth Ferguson, a 13-year real estate veteran, host of a real estate TV show, host of a real estate investment podcast, and I'm also the author of the real estate book, Sell for More. So let's get right into it and talk about interest-only financing and how these mortgage payments are structured. Before we get into an example, it's really important for us to understand how mortgage payments are made up. And we have two parts to a mortgage payment. We have what's called the P and we have the I. The P stands for principal, and then the I stands for interest. The principal is the amount of the mortgage payment that's going down to pay off the principal or the debt remaining. So we'll have the debt remaining. The interest is the percentage of the total amount borrowed that you are paying the lender for the privilege of them giving you their money to use for a given period of time. So whenever we talk about mortgage payments, we have P and we have I. So principal and interest payments. Let's go through an example of principal interest payments in action. So let's say we borrowed $1 million from a lender and they are charging us 4% interest. What do our principal and interest payments look like? And there's no way I can memorize these numbers, so I've got them handy right here on my phone. I won't even pretend I did. So we'll look at year 1, and then we'll look at year 10. In year 1 for interest, we have paid $38,944 in interest. Now the principal, so the amount we've paid down from the total $1 million we've borrowed is $29,438. Depending on your interest rate, you may pay more in interest than you do in principal. When rates go higher, you're paying more interest than you are paying down the principal amount. Now, what happens all the way down to year 10? Because with P&I payments, with principal and interest payments, we're not only paying interest to the lender, which is the fee we pay for the privilege of borrowing their money, but we're also paying down the remaining balance. What this means is over time, the amount remaining becomes less and less and less, so we pay less and less interest on it. When we get to year 10, the amount of interest we're paying now is $26,388 in interest, which is a whole lot less than the $38,000. And then our principal is $41,994 going towards paying down the remaining debt. So how much is left of the $1 million we originally borrowed at the end of year 10? We have $688,128 remaining of the $1 million. This is your typical traditional mortgage payment. You're paying down the mortgage and you're also paying the interest. But here's the thing when it comes to real estate investing. What if we could put our money to work differently? What if we could improve our cash flow so we can make better improvements to the building from day one and improve the property? Because here's the secret. Nobody gets rich off of paying down a mortgage. Paying off a mortgage over the long term, it's a long-term chip away at the debt, but nobody's building massive wealth just by paying down mortgages because it takes so long to do. We want to take control of our investment opportunity, and I'll put a link right up here to a video I did talking about the value add strategy. So where does interest-only financing come into play? So we'll start interest-only. Interest-only financing can come in a couple different forms. One, it could be a bridge loan. A bridge loan is a temporary stopgap type of financing that's meant for the short term before you can bring on conventional debt. And conventional debt is really a long-term mortgage product where the rates are cheaper because the risk is less. In both instances, we can get interest-only financing. And what this means is we actually don't pay down the principal, we are just paying the interest or the percentage we're paying to the lender based on the amount we've borrowed for the privilege of using their money. This has the effect of improving cash flow because all of a sudden we're not paying the principal part of the payment, we are just paying the interest. We're just basically renting the money from the lender and we don't care about paying down this $1 million. So what does this look like compared to your traditional P&I payments? Well, for the first year, a P&I payment is $68,382. This is our total amount that's gone to service our debt, including principal and interest. If we're just doing interest only at 4% for $1 million borrowed, all we're paying is $40,000 because we're paying 4% of the $1 million. We're not worried about paying it down. Here's the question you have to ask yourself. There's about a $30,000 difference between the principal and interest payments in this situation and the interest-only payments. And let's say we have a 5-year interest-only period where the lender will only charge us for the interest we owe for the first 5 years, and it will convert into traditional P&I payments for the remaining, let's say, 15 years. This is very common with larger multifamily properties. The question we have to ask is, for the first 5 years, saving $30K a year that would normally be going down to paying down the debt. So that's what, $150,000? Could we put that $150,000 to work and improve the property more than what we would get with our regular mortgage pay down over the long term? Because by year 10, we've paid it down to about $688. If we could take the extra cash flow in the first 5 years and do more improvements, take control of the value of the property, really implement a value add plan and improve it, do all sorts of renovations, can we come out farther ahead when we sell the property down the road? If you have a strong value add plan where you're buying a property for under market value because it has rents below market value, maybe it's dated and needs renovation, maybe it's mismanaged. If you have that strong upside potential based on the work you're doing, so you're controlling the valuation of your property, you definitely want the cash flow in this case because you're able to get a better bang for your buck, earn a better return on that $150,000 in the first 5 years than just slowly chipping away at the mortgage. Remember how I said before that nobody gets rich off of chipping away at a mortgage. Sure, it reduces your overall debt, but it's not forcing the appreciation of the asset and putting the money to work extremely hard. This is the benefit of interest-only financing because it frees up the cash flow, and whenever we're doing a value-add strategy with lots of renovations, cash flow becomes tight because we have vacancies in other units, we're putting money into remodeling different units, maybe the exterior. Cash flow is very, very important. So instead of being extremely tight over here, chipping away at the mortgage that's not really going to make a big impact on our overall returns, we much rather have more of a cushion in terms of cash flow with the interest-only financing. It's a huge advantage when you're implementing a value-add strategy because it makes your money work so much harder. You can do better things with your money rather than just slowly chip away at a mortgage year after year after year. The whiteboard became incredibly messy. Again, this seems to happen quite a bit, but I hope you found this video useful. So if you're interested in learning more about the deals I'm currently looking at, head on over to callseth.com and set up a free 20-minute phone call with me. And if you like this video, if you found this useful, hit the like button, leave a comment, let me know what you think, and until next time, happy investing.